I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes.
Guy has a point. Peter Lynch didn't achieve a 29% net annualized returns by listening to macroeconomic forecasts, and he's not alone.
Charlie and I don't pay any attention to macro forecasts.
When it comes to investing, here's why you probably shouldn't spend too much time on macroeconomic forecasts.
It's the economy, stupid. Okay?
To put it mildly, economies are very complex. Hundreds of millions of workers, consumers, producers, and suppliers, modeling the interactions and behaviors of all of these actors and how they react to inflation, interest rates, pandemics, and Labubu dolls.
They were all trying to get their hands on the latest edition of Labubu.
No, what?
Is pretty much impossible without making a lot of simplified assumptions. Assumptions like people being rational financial decision makers. And when the pros use these models, the results are not that great. There are significant forecast errors when comparing to the actual GDP outcome.
Come on, you loser!
But let's assume for a second that you got your GDP forecast correct. That is only one piece of the investment puzzle. For stocks, you then need to know how this will impact individual companies. Because of the use of leverage, both operational leverage and financial leverage, companies' profits tends to swing more than the overall economy. Here's the standard deviation of US GDP and company earnings. As you can see, the company earnings are more volatile. Finally, you need to know how traders in the market will react. What expectations are already priced in? That is why you can have a stock drop after improving fundamentals, because that improvement wasn't large enough.
Not quite my tempo.
It was below expectations. And swings in stock prices doesn't just reflect changes in company fundamentals, but also changes in investor sentiment. As investor and writer Howard Marks writes in one of his memos, in the short term, the ups and downs of prices are influenced far more by swings in investor psychology than by changes in companies' long-term prospects. Market participants' tendencies to overreact to new information and follow herd behavior makes stock prices swing more than both company fundamentals and the overall economy. Now, this makes financial forecasts a lot harder than in physics, for example. In physics, you have natural laws that you can rely on. Electrons don't care about your feelings, but the markets kind of do. Now, for what it's worth, I think economics is a super important scientific field. Many countries around the world would benefit a lot if their governments read a 101 econ book. I'm just saying that from an investing point of view, I kind of agree with Peter. Yes, we are on a first name basis. That it has little role in an investment process. So instead of spending those 13 minutes listening to some economist on Bloomberg, focus on what matters more. Like reading a 10K or learning about businesses. Focus more on micro than macro. Thanks for watching.